Hello everyone, and welcome back to Colin Investing. In today's video, we're diving deep into the market's key events and delivering the analysis you need to stay ahead. Consider this your go-to update for understanding the forces shaping your investment decisions. We'll be covering everything from the Federal Reserve's latest concerns to Trump's potential tariff impacts, shifts in U.S. debt holdings, and of course, what's new with Apple. So buckle up and let's get started with today's market movers. Building on our intro, let's dive straight into the first market mover, the Federal Reserve's meeting minutes. Now, the big kikoisi here is that FOMC members expressed real concerns about rising inflation, and what's fueling these concerns? Primarily, it's the potential impact of Trump's policies. We're talking about things like changes to trade and immigration policy, potential gold disruptions throwing supply chains into chaos, and even just the possibility of continued strong household spending. Think about it. Any of these factors could easily push inflation higher, and testingly, some Fed contacts even suggested that businesses might try to pass any tariff-related cost increases directly onto consumers. Imagine the impact if companies start raising prices to offset those tariffs. However, that's not the whole picture. The discussions also touched upon the possibility of slowing down, or even temporarily pausing, the reduction of the Fed's balance sheet. This is largely tied to the ongoing debt ceiling issues. The Fed doesn't want to be tightening policy too aggressively, while here is uncertainty around government borrowing. So, what was the market reaction to all of this? Surprisingly, it was slightly positive. This might seem counterintuitive given the inflation worries, but the market interpreted the Fed's tone as more balanced and neutral compared to some of their previous statements. It's a sign that the market is hanging on every word from the Fed, trying to gauge their next move. Ultimately, the market's slight positive reaction suggests a sense of relief that the Fed isn't currently signaling a more aggressive tightening path. Keep that in mind as we go forward, because how the Fed manages inflation and its balance sheet will significantly impact the other market drivers we will discuss. This brings us to a critical shift in the landscape. Trump's executive order, which signals a move to exert greater control over independent federal agencies, including the regulatory functions of the Fed. It's a power play that could have significant implications for how monetary policy is shaped and implemented. And that's not all. Trump is also planning to potentially impose a 25% tariff on imported cars, semiconductors, and pharmaceuticals, possibly by the 2nd of April. Now, this is where things get really interesting, especially for the auto industry. The auto industry, as many of you know, is incredibly reliant on complex global supply chains. Think about all the components that go into making a single car. They often come from dozens of different countries. A 25% tariff could throw a major wrench into the system, leading to increased costs for manufacturers and ultimately higher prices for consumers. Imagine the impact on your next car purchase, but the potential impact goes far beyond just the auto industry. These tariffs could strain relationships with our trade partners, potentially leading to retaliatory measures. We could see a tit-for-tat situation unfold, with countries imposing tariffs on U.S. goods in response. It's a complex web of economic and political factors that are all interconnected. Consider a situation where other countries respond by placing tariffs on U.S. agricultural products. How would that affect farmers and the broader economy? So, as investors, we need to be aware of these potential risks and how they could impact our portfolios. Are there companies that are particularly vulnerable to these tariffs? What are the potential winners and losers in this scenario? These are the questions we need to be asking ourselves as we navigate this evolving market landscape. Remember that the situation is dynamic and subject to change, so staying informed is key, and that's where U.S. debt comes into play. In December 2024, we saw that the top foreign holders of U.S. debt, namely Japan, China, and the UK, actually reduced their holdings. Now, why is this important? Well, the market closely monitors these changes because the U.S. government needs to finance its significant deficit, especially now, while the Federal Reserve is simultaneously reducing its balance sheet. Think of it like this. If the U.S. needs to borrow money and its usual lenders are pulling back, that could create some turbulence. However, it's not all doom and gloom. Despite these reductions from the top holders, overall foreign net inflows remained positive, coming in at over $87 billion. So, while some countries are selling, others are buying. This is a key point, indicating a more nuanced picture than a simple mass exodus from U.S. debt. So what's driving these individual decisions to sell? In Japan's case, it's largely due to interventions aimed at stabilizing the yen. To prop up their currency, they need to have ample reserves of foreign currency, so they are selling dollar-denominated assets, like U.S. Treasury bonds, to get that cash. China's selling is more likely tied to diversification efforts, geopolitical concerns, and a desire to diversify its foreign reserves. They're increasingly looking to hold a broader range of assets, including gold, rather than relying so heavily on US debt. Finally, for the UK, it often comes down to trading strategies. Hedge funds based in the UK might hold US Treasury bonds as part of sophisticated trading strategies, like a basis trade to profit from small price discrepancies. So their selling isn't necessarily a reflection of a negative view on the US economy, but more about leveraging market opportunities. Keep these factors in mind, because the flow of money in and out of US debt has a direct impact on interest rates and the overall health of the US financial system. Now let's shift our focus to a major player in the tech world, Apple. Remember that earlier discussion about potential tariffs and their impact? Well, it directly affects companies like Apple, which rely heavily on global supply chains and international markets. Apple is making moves to stay competitive, and one of the most significant is the release of the new iPhone C4, which some are calling the iPhone 16e. What's interesting about this phone is that Apple is very clearly targeting the lower-end market. It's equipped with the A18 chip, as well as Apple's own 5G chip, signaling a strategic push to capture a larger share of budget-conscious consumers. And to further emphasize that point, the SE4 is priced lower than both the iPhone 16 Pro and the standard iPhone 16. This makes it a much more accessible option for consumers who want the Apple ecosystem without the premium price tag. One analyst is predicting shipments of over 20 million units, which would be a huge success for this model. But what about those pesky tariffs we talked about earlier? Bank of America has done some analysis on this, and they believe that tariffs pose a manageable risk for Apple, but they also acknowledge that it may necessitate price increases. It really boils down to how Apple decides to absorb or pass on those costs to consumers. Also, let's not forget that Apple has a very strong lobbying presence in Washington. Here is a real possibility that they could secure tariff exemptions as they have in the past. Ultimately, Apple's ability to navigate these challenges will be key to its continued success in the global market. It's a balancing act between innovation, pricing, and political maneuvering, so it's a space to keep a close eye on. Now, before we wrap things up, it's crucial to address a few important points. The content we've covered in this presentation is for informational purposes only. While we strive to provide accurate and achievable analysis, it's essential that you conduct your own thorough research before making any investment decisions. Remember, the financial markets are complex and dynamic, and past performance is not indicative of future results. Investing inherently involves risk. Here is always the potential to lose money, and it's important to carefully consider your own risk tolerance and financial situation before putting your capital at stake. It's also wise to consult with a qualified financial advisor who can provide personalized guidance based on your specific needs and goals. A financial advisor can help you assess your risk profile, develop a sound investment strategy, and navigate the complexities of the market with confidence. So, take what you've learned today, do your homework, and seek professional advice when needed. It's all about making informed decisions and taking control of your financial future. And with that, we've reached the end of today's deep dive into the market's key events and analysis. I hope you found this update helpful and informative. Before you go, remember to like and subscribe to Colin Investing for more finance and investment insights. By subscribing, you'll stay updated on the latest market trends, in-depth analysis, and actionable strategies to help you make smarter investment decisions. We're committed to providing you with the knowledge and tools you need to navigate the ever-changing world of finance. Also, please share this video with your friends who might find it valuable. The more people we can reach with clear, achievable financial information, the better. And don't forget to leave your comments and questions below. We love hearing from you and value your feedback. Your questions help us shape future content and ensure we're addressing the topics that matter most to you. Whether you have a specific question about something we discussed today or a suggestion for a future video, we're all ears. Thank you so much for tuning in, and I look forward to seeing you in the next video.